Good evening, and welcome to another Killick & Co webinar, where we try to break down and give you insights into the world of personal finance to help with your saving and investing. My name is William Stevens, and I'm the Head of Financial Planning at Killick & Co, and I'll be your host for this evening. On the 30th of October, Rachel Reeves unveiled her first budget of the new government, and this evening we're going to try and work through some of the plans that were set out for taxation, legislation, and spending throughout the next term. This evening, we'll take a look at some of those areas that have really impacted on savers and investors and try and get an insight from our panelists as to what they are thinking about and talking about now with clients to try and make the most of those changes. I'm joined this evening by my colleagues. We've got Sean Robson, who's a partner and head of wealth planning, Rachel Winter, partner and investment manager, and Ben Highland, who's associate planning director. Just before we get started, there's a couple of housekeeping points to get through. This webinar should be 30 to sort of 45 minutes in length of conversation, after which we'll move into a bit of Q&A from the audience and a few questions that we had submitted ahead of time by attendees. We should hopefully aim to try and wrap up within the hour. If you do have any questions during the webinar, please do use the Q&A function at the bottom of the screen to submit them ahead of time, and we'll try to answer as many as we can. If we can't get to your question today, what we will do is we'll make sure that someone from Killick follows up with you with an answer to your question over the coming week. Without further ado then, we will get started. And I guess, Ben, let's start with you. Having had a chance to digest some of the changes and the content from the budget, you've had a few conversations with clients over the last weeks. What change in the budget has had the biggest impact or caused the most surprise to you and your clients?
I think the biggest change that I've been talking to clients about is inheritance tax, and namely inheritance tax on pensions. So the current position, of course, is that most defined contribution pensions are outside of one's estate for inheritance tax purposes, therefore don't suffer 40% IHT upon death. What was announced at the budget is that from April 2027, that is going to change, and unused pension funds upon death will be subject to 40% inheritance tax. Now that's UK registered pensions and some international pensions also, and also some lump sum death benefits from defined benefits of final salary type pensions will also be caught in that inheritance tax change. Say that's coming in in around 2 years, and the pension scheme administrator is likely to pay the inheritance tax, which must be paid within 6 months at the end of the month in which the death occurred. So I would say that is a real step change from the budget.
Yeah, I think the previous position was pretty well understood for a lot of individuals, which were that pensions were outside of the estate and therefore not subject to inheritance tax, which made them both a good retirement planning vehicle and a good inheritance tax planning vehicle at the same time, which sort of made life a little simpler for individuals. Sean, I guess from a planning perspective, let's jump over to you. What have you been discussing with clients as a result of this? What changes are you making? How is this impacting on the clients that you're speaking to?
Yeah, thank you. And in terms of changes to pension rules, I think it's worth mentioning that these new rules are not yet written into legislation. There's an ongoing consultation with the pension industry, and we've got sort of over 2 years before they take effect. Now I'm getting a lot of questions from clients about whether these rules will actually make it into the statute books. And if they do, potentially would a Conservative government roll them back in the future? And I think it's important to note that consultation is not about whether the rules will be changed. That's inevitable, but it's about the way, the best way to implement them. As the initial draft is looking like pension providers and pension administrators are going to be responsible for doing a lot of that work. As Ben mentioned, they're going to be, having to calculate the IHT due, and they're also going to have to arrange for that IHT to be paid directly to HMRC from the pension itself. So there's a lot of work for the pension industry to do over the next 2 years, and I think that's why that time frame has been put in place to make a workable process, and to allow pension providers to be able to do that going forward. And secondly, to that question, I think it's impossible to know what a future government might do. I do think it's highly unlikely that they'll roll back these changes. I think it's been kind of widely held opinion that this was a generous benefit for the pensions that probably distorted to a degree the way that pensions have been used over perhaps the last decade. I think a couple of key questions that we're hearing from clients now, for anybody over the age of 55, the most common question that we're hearing is, should I be taking my tax-free cash now? I think with these changes, taking tax-free cash by the age of 75 seems to be like a no-brainer for almost all pension savers. And reason being, if you pass away after the age of 75 without taking your tax-free cash, then these funds that would have been tax-free in your own hands could end up suffering 40% in IHT, but also subsequently up to an additional 45% in income tax when your beneficiaries come to draw from the pension. So that element of double taxation that Ben mentioned can really lead to the pension pot being eroded significantly if you don't get the timing of taking your benefits right going forward. And I think that's really key here. The timing of taking your tax-free cash really needs to be considered in the context of your own needs for income and capital, alongside any plans you might have from an estate planning point of view, and potentially how that rolls into your strategy for moving perhaps assets to the next generation. So beyond sort of tax-free cash element and how that might be impacted going forward, I think anybody that's already in retirement and is already drawing an income from their investments, the most common question we're seeing is, should they change the order in which they're drawing income from their assets? And for anybody who's been leaving their pension to grow outside of their estate over the last few years, perhaps with no intention of ever drawing an income in their lifetime, now is absolutely the right time to be reviewing that strategy and considering whether it's the right thing to now start drawing benefits from the pension, in effect reversing the approach that we've seen a lot of clients take over the last few years. And it may be appropriate now to start paying some income tax yourself on those withdrawals, to start depleting the value of the pension over your lifetime. That really needs to be considered in the context of your overall income plan, your overall income strategy, and making appropriate adjustments depending on personal tax position. As an example, using the pension now to start taking an income and using that income to potentially to gift to your beneficiaries may be a great way to pass the pension on during your lifetime, whilst taking advantage of the gifting out of surplus income exemption, as an example.
Yeah, there's quite a lot of adjustments to be made there, I think, to individuals' financial plans from the historic position. And there's been a few reports in the media that have suggested, pensions could be a death for certain types of pensions or certain types of pension savers, which probably a little extreme. I mean, Ben, pensions are still a worthwhile wrapper, still worth saving money into, aren't they? So why don't you talk about how that actually works in reality after the inheritance tax might be paid, for example?
Yes, and I suppose my point here is a bit of a counter, if you like, to that point of taking income. And as Sean rightly says, there could be an element of double taxation, the IHT on the pension post 27, and then indeed the beneficiaries taking money out if one dies after 75 and paying income tax. But in certain circumstances, we think the pension may still be a very good wrapper from a legacy perspective. And to use an example for this, let's say you had the parents in a family unit who pass away when they're in their late 70s or early 80s, for example, and post 27, of course, inheritance tax will be levied on their pensions if they're above nil rate bands, etc. But if those pensions then go down a generation to their children, let's say there were a son and a daughter who are in their 40s, just for argument's sake, doing well financially themselves and therefore don't necessarily need to draw from the pension at that point, and it may well be that the inherited pension is a retirement vehicle for them, say 20 years on from that. The great thing going forward, we think, from what we can see in the legislation at the moment, is that if you can keep the pension wrapper, the beneficiaries can keep the funds in there, and those funds will roll up without income tax or capital gains tax within the pension. And if that's done for, say, 15, 20 years until their retirement, and then they, for example, were to drop down to be a basic rate taxpayer and can draw funds at a 20% income tax rate, and indeed because they retain the wrapper, they have control over those drawings, and with good planning, hopefully can mitigate income tax where possible. It still actually may be quite a powerful legacy vehicle, albeit, of course, relative position pre and post 27, because of that inheritance tax, it will get worse. But in certain situations, whilst there is that double taxation that Sean talks about, if there's a period of quite long roll up in the pension and then that's managed on the way out, it may not be the worst from a tax perspective.
Agreed. And pensions obviously still do come with a significant amount of tax relief on the contributions that you make during your lifetime, and they should always primarily be used as a retirement planning vehicle anyway. But there are still these added benefits, I guess, to that gross roll up you mentioned and that tax efficient wrapper that can be inherited. But I think it does change the view on them slightly. And Rachel, you and I were talking about how this has impacted on your conversations, particularly from an investment strategy perspective. Do you want to expand on that a little bit for everyone here?
Yeah, of course. So I think the new rules could result in quite a change of investment strategy for many pension owners. So when we're thinking about how much investment risk to take for a client, we tend to consider their time horizon. So if someone needs to draw on their portfolio in the next couple of years, we probably wouldn't take a very high amount of risk for that client. If someone doesn't intend to touch their portfolio for 10 plus years, in that case, we would probably take quite a high amount of risk. Before the budget, a lot of clients would say to us, the pension is the last thing that I'm going to draw on, or maybe I actually don't even intend to touch my pension at all. I intend to pass that down to my children. And if that's the case, then we would consider the children's time horizon and appetite for risk when deciding what to do with the portfolio. So we may have taken quite a high level of risk there. But now we've had this change in rules, it's possible that many clients may look to draw on their pensions earlier, and therefore we may want to lower the levels of risk that we're taking.
So it's impacting across the spectrum, both in terms of the financial plan and the investment strategy there. There were a lot of other changes announced in the budget, as you'd expect from a first budget of a new government. Most notably, we saw other changes from the inheritance tax perspective. Sean, are you able to talk us through some of those other changes, just at a high level, give us a view of what else has been implemented or going to be implemented, I should say?
Yeah, absolutely. And I think beyond the main headline change to pensions, as you say, Will, there were other inheritance tax changes announced by the Chancellor in the budget. And as a reminder, inheritance tax is broadly charged at a rate of 40% on all assets over your nil rate band, which is currently 325,000. And in some circumstances, you might also qualify for what we call a residence nil rate band, which is 175,000, giving you the ability to protect up to £500,000 worth of assets in total from inheritance tax. For a married couple, and enabling them to pass up to £1 million of assets on death completely inheritance tax free. Those rates of sort of nil rate band and residence nil rate band will stay fixed at these levels until at least the 5th of April 2030. That's worth noting. That was an extension on what was already previously set out by the previous government to 2028, has been extended by Rachel Reeves to 2030. I think prior to the budget, certain assets and investments benefited from 100% relief for inheritance tax, meaning no IHT is due on them, namely property that qualifies for either business property relief and agricultural property relief. Chancellor announced that both of these reliefs will be reformed from the 6th of April 2026, and the full 100% relief from inheritance tax will be restricted to the first £1 million of combined agricultural and business property relief only. Anything above this amount will be liable for IHT, charged at a rate of 20% on the value in excess of this cap. So a significant change there. The Chancellor went even further with a change to IHT relief on available for holders of AIM qualifying shares. Under the previous rules, qualifying investments in AIM shares held for a minimum of 2 years, the death would be free from IHT upon death of the holder. And the government announced that this relief itself will also be amended to a 50% discount on the IHT rate, meaning that in effect, AIM shares will be liable to IHT discount rate of 20%. I think when you look at the impact of all these measures from an IHT point of view announced in the budget, together with asset price inflation in the future, I think what we're going to see is a greater proportion of estates will fall within the scope of IHT than ever have done before.
Yeah, and we're beginning to see, I think, some of the fallout from that already. For many people watching would have seen the news yesterday, the protests in London from the farmers. But it is, it's a major consideration for any business owner, any farm owner, or anyone who had a holding of AIM shares. Ben, in terms of the conversations you are having and how that is impacting your clients, what are the sort of strategies that people are beginning to look at? How are you thinking about these changes, and how do you adapt to account for them?
Yeah, so starting on grouping together business owners and farmers here in this piece, as there are sort of similar things to think about here. I suppose that one of the first things that comes to mind is for the business owners and the people who own the farm to be thinking about perhaps insurance where perhaps they weren't before, and that insurance could take the form of whole of life insurance, so it's on the life of someone, runs for their lifetime, and makes a guaranteed payout upon their passing, which is matched to the potential IHT liability. And it's a case of looking at that IHT liability now, but also reviewing it on an ongoing basis to ensure that the insurance policy keeps pace with the quantum of the potential IHT charge. And what this does, it doesn't actually mitigate the inheritance tax per se, but it does provide the business or the farm the liquidity to pay some or all of that inheritance tax charge. Now, that's something that really, in a lot of cases, these business owners and or farmers wouldn't have had to think of in this context, because there was no IHT when these assets were passed down. So that's worthy of consideration. Another thing that people are thinking of is if you've got those shares in a privately owned business or indeed farm assets where they would have passed on death, is there a consideration to be given to passing them during your lifetime? And then the 7-year clock begins to tick, after which they are free of inheritance tax. So that's also a consideration, with due consideration there to be given to any capital gains tax consequences of making gifts of shares and assets during one's lifetime. But I think these are real step changes and conversations that people in those positions perhaps weren't having to have before, because perhaps they had gone through with the intention that those assets would just pass down on death inheritance tax free, whereas now those are considerations that have come to the forefront as a result of this change. Another sort of thought on AIM shares is it's the trade-off between the potential volatility and the risk of those shares, with them being earlier stage businesses, versus in the context of the new relief.
Yeah, we can talk about the CGT more in a minute, but I think that's an important point to clients to weigh up as well, is that if you are looking at gifting any asset to future generations, whether that's shares in a business, whether that's artwork, with the exception here of cash, it is going to be a disposal for the purpose of capital gains tax in most instances, and therefore you're weighing up the possibility of having to pay some capital gains tax now versus having to pay inheritance tax further down the line. Sean, would you add much more? Ben's been quite comprehensive in his coverage there.
Yeah.
Have you got anything to add on to that?
No, I think maybe just in the summary, but I think there's so many changes impacting IHT. I think the immediate action for clients is to take stock on how these changes impact their own estate plans. I think what was once sound planning, appropriate pre-budget, may no longer be the case going forward. And I think once you understand the impact, you can then start to consider what actions to take. And Ben's given some ideas there in terms of the theme and across AIM shares, etc. I think at that point around AIM, while a reduction in the rate of business relief applicable to AIM shares introduces an effective 20% rate on the death of the investor, I think that budget announcement has probably largely been welcomed by investors and providers. I think many of whom feared that IHT relief might well be eradicated for AIM shares, which would have caused potentially an influx of forced sellers. So I think Ben's covered that really well, and I think that really covers most of the kind of key points from the other changes that we've seen.
Thank you. And yeah, Rachel and I had a conversation on the day about the result from the AIM market, the reaction that we saw in investment markets there. I mean, Rachel, from your perspective, we did see that uptick on the day. Clearly, the market reacted well to the information that they weren't going to lose all of the relief that was being applied, lose 50% of it. So yes, it's dropped from you used to have 0%, now you're going to have 20% instead of 40%. So still better than 40%. But has that changed? Has that materially impacted on the view, do you think, of the AIM market as a whole, that sort of index in terms of how we see it, how others see it?
Well, it is still very high risk and it is still very volatile. So, as you say, on the day of the budget, I think people took the news quite well that the inheritance tax relief was not being taken away entirely. So, on that day, we did see the AIM index rising by about 4%. However, you need to look at the slightly longer term. So, looking at the index, it actually lost about half of its value between 2021 and 2023. There's a couple of reasons for that. One is that UK shares have been quite out of favour since Brexit. And then when interest rates start to rise, we tend to find that investors move away from smaller companies. So the AIM index has this unfortunate combination of smaller companies based in the UK. So it has been very unpopular with investors over the last couple of years. So I think people do need to be mindful of that when they are considering holding shares for this inheritance tax relief. Longer term performance has been better, but short term volatility has been very, very high indeed.
Yeah, absolutely. I think when we look at AIM and its use for clients, if we're recommending it from a planning perspective, it tends to be, when we have maybe exhausted other options, time restraints are in place. With gifting, we're talking about the 7-year rule all of the time. If an individual is in later life and doesn't have 7 years to potentially benefit from the tax relief, the AIM can be a great way to sort of get some tax relief in a shorter period of time and needing to hold the assets for 2 years. So they can, but it's all about, as you say, high risk. So it's about the right client circumstances for it. We've touched on CGT a couple of times, so it's probably worth diving into that in a bit more detail. So Rachel, I'm going to come back to you. There was a change in capital gains tax on the day, and therefore this has almost certainly driven some changes in your mind and how you're managing portfolios on a day-to-day basis. So maybe talk a little bit about the lead up to the budget, what was going on there, but now how you're thinking about capital gains tax when you are running a portfolio on a day-to-day basis.
Yes, actually, capital gains tax was one of very few pleasant surprises in the budget. So before the budget, the basic rate of capital gains tax on shares was 10%, and for higher rate taxpayers, it was 20%. And there had been a lot of rumours that the rates of capital gains tax would be raised to make them in line with income tax, i.e., 20% for basic rate taxpayers and 40% for higher rate taxpayers. So before the budget, we did see a lot of clients taking gains on their investments in order to avoid those potential higher rates of capital gains tax. On the day, it turned out that the basic rate of capital gains tax for shares was raised to 18%, and for higher rate taxpayers, it was raised to 24%. So nowhere near as bad as people expected. So that was a very pleasant surprise. But despite now having these slightly higher rates of capital gains tax, we would still encourage clients. We use the phrase, don't let the tax tail wag the investment dog. So don't let your portfolio be dictated by the tax rates that are available. So if you have an investment that has got a gain on it, but you think it's no longer the right investment for you, then generally it is the right thing to do to sell that investment, take the hit on the capital gains tax, and buy an investment that is right for you. So that advice was correct before the budget, and it hasn't changed now.
Yeah, I think we've been seeing a directional shift in capital gains tax over the last few years. Conservative government brought down the allowance time and time again, and now we've seen the rates rise as well. So as you say, if you have an opportunity to move into an investment which you think is going to generate a much better return over the long term, you're going to get that return, that extra, what would have been a loss in terms of the amount you've given up for capital gains tax back by holding it for the long term. And we are long-term investors, so we just want to make sure that our clients are doing the right things. But Sean, with the change in capital gains tax and your client base, the sort of things you've been working through, how are you factoring that in now that we're in the sort of new world, slightly higher capital gains tax to pay. Have you made changes to any of the plans you've got for your clients?
Yeah, and I think that, as you say, that kind of landscape of rising CGT rates, falling exemptions, or freezing of allowances that we've seen over the years really does focus the mind on where can you, kind of store and grow your wealth in a tax efficient environment and beyond of the usual tax wrappers we discuss regularly, your ISAs, your pensions, and we think, if you're continuing to, save and invest for the future, that they still continue to be the right way to make use of those exemptions each and every year. I think there's clearly a trend with CGT that it's been creeping up over time and continuing to head in that direction. As Rachel mentioned, perhaps it didn't go as far as what some commentators had speculated pre-budget, which is good news. But a sense that perhaps is there still room for that to continue in that direction in the future? And I think in that context, like, it makes sense to consider sort of taking some capital gains each and every year, particularly where perhaps there's an added investment reason to do so, to just chip away at those gains on an annual basis rather than storing up huge amounts of capital gains over a number of years and potentially running into a position where those CGT rates are higher in the future and that tax position only getting worse. I think that's, conversations we continue to have on an ongoing basis with clients. And then beyond the sort of, I guess, what I call the sort of traditional tax planning around ISAs and pensions, what else can you be doing? And we've covered this in other webinars previously, and maybe not one to get into too much today, but other options include things like offshore bonds that allow you to save and invest for the future and benefit from the tax benefits thereof, what we call gross roll-up. Whilst those funds are invested and continuing to grow, there is no immediate tax charge. The tax charge comes when you look to withdraw funds in the future. But another great way to sit alongside those ISAs, pensions, and main accounts in terms of growing your investments tax efficiently.
Completely agree, and that that actually probably links us quite neatly onto the next point, which is the slightly more positive news from the budget, which was probably more to do with emissions than anything that was actually included in the budget, which would that there were no changes to the ISA and pension contribution allowances. So they have retained their levels, £20,000 per person per year for an ISA, £60,000 for a pension, subject to your relevant earnings, obviously. There was also no change to the carry forward allowance. So we've got quite a bit of good news in there for people who are still saving and investing. There's still a lot of options for putting money away on a regular basis and benefiting from more efficient tax structures. Then these are obviously key parts of any financial plan. So really good news generally. I don't know if you've got anything particularly you wanted to add on those.
Yeah, so I think it's just, I suppose, reiterating the importance of those allowances. So, for example, pensions, of course, from a legacy perspective, big change from 27. However, there are still very generous tax reliefs associated with pension contributions. So on the way in, if you make a personal contribution subject to relevant earnings and other considerations, you get income tax relief at your highest marginal rate, so up to 45%. So that's an instant uplift provided by HMRC. Or if the contribution is coming from a business, it can get corporation tax relief for that business. So on the way in, generous reliefs. And then whilst the money is within the pension, no capital gains tax nor income tax. So it rolls up free of those two. So it especially pertinent if you're building up pensions over decades, which a lot of people are. That's a very powerful set of reliefs. And when one comes to draw pensions in their retirements, you get up to 25% tax free, subject to limits of the lump sum allowance, which are different for different people. And then it's taxed at your marginal rate of income thereafter. So still a very generous set of reliefs on pensions. And actually just linking back to that point on capital gains tax, and does someone look to take some gains on a portfolio of shares to reinvest? Not only reinvesting in another investment that might be more appropriate going forward or have greater return potential, you could also look at it if you paid, let's say, 18% of capital gains tax. If you then put some of that money into a pension and got 40% tax relief if you're a higher rate taxpayer, you're already in a better position as a result of the tax relief. And then there's the investment piece alongside it. So it's, I suppose, reiterating the importance and the fact that pensions are still very tax efficient, and indeed ISAs remain so too. No capital gains tax or income tax on funds from ISAs. So they can roll up again. If that's happening over a longer period, that could be a very powerful effect on when you actually come to draw from your assets.
Yeah, I think no one should ever be afraid to potentially take some capital gains to reinvest the money into an ISA or a pension if it's going to be for the long term in particular, because the benefit you're going to see back over, for the compounding free of any further taxation is going to be significant. That's even before you consider the tax relief on pensions. And I think some people, they'll now be weighing up the pension versus ISA conversation. Maybe we get into that when we're in the Q&A in a little bit and get everyone's view on it. Just before we do get towards the Q&A, though, there probably is one more thing that we need to get to, which is the budget also covers spending. So, we have a look at the impact that has had in terms of the interest rate and inflation outlook. It'd be remiss of us not to discuss how that's impacted on everyone. Rachel, would you be able to talk us through just quickly an overview of where we are today, 3 weeks on from the budget, when we look at the market?
Yeah, sure. So it is expected that the budget will be a bit inflationary. And the reason for that is that minimum wages are going up and more costs have been levied on employers, for example, the new national insurance contributions. And that means it's likely that companies will now have to raise their prices to cover those costs, and that will result in a bit of inflation. If we've got higher inflation, it's likely that interest rates here in the UK will have to remain higher for a little bit longer. So as a result of that, we have seen prices in the government bond markets adjusting to make the yields on those government bonds higher. So we have seen government bond prices dropping a bit and the corresponding yields rising a bit. So actually, for anyone who's looking to invest in government bonds, they now look a bit more attractive now than they did before the budget. So to put that into context, the 5-year government bond had an annualized yield of about 3.5% back in September. Moving forward to today, that yield has now gone up to about 4.3%. So looking much more attractive there. And actually, gilts can be a really attractive, very tax efficient alternative to cash, particularly for higher rate taxpayers and additional rate taxpayers. So please do let us know if you have any questions about government bonds, because they can be a very good option for many people.
Absolutely. And I'm sure most of our clients have heard about government bonds at some stage through their investment manager. We've been big advocates of them and the tax efficiency and returns that have been available there. Perfect. Well, look, I'm sure we could spend all evening specifically just talking about the various changes that took place in the budget, but we do want to make this an interactive session and open it up for some Q&A. Just before we do that, we are going to put a quick poll on screen where there are quite a lot of people here today who maybe haven't had a chance to talk to an advisor yet about some of the changes in the budget. So if you would like an advisor at Killick & Co to reach out to you to discuss how the changes in the budget may have impacted on you and your circumstances, please do select yes and let us know. We will move into the Q&A section now. We had a few submitted ahead of time, so we'll start with one of those. We are getting quite a few questions through. We'll try to get through as many of them as we said, as many of them as we can, as I said at the start. For those that we don't get to, we will come back to you on email directly. We will try and answer them as best we can. Where they are quite specific, we will need to potentially consider coming back to you directly as an individual rather than answer them here today. Obviously, we can't stray into the realm of advice, so we will have to just stick to general answers on here today. Ben, let's start with one that we got in by email ahead of time. In fact, I believe this individual got in a question input to us within about 24 hours of the invite going out. A really good question, because something that we've touched on today but not covered in detail. Have there been any changes to inheritance tax perspective that might affect life insurance policies? This individual's got a will set for their children, a property in that that's going to be potentially subject to inheritance tax. There's a mortgage attached to said property, so inheritance tax is only on the equity element that they've got. But if they were to die, they've taken out a life insurance policy to cover the inheritance tax on that, so that they're not forced to sell the property. Have there been any changes? Do they need to consider anything as part of that?
Yes, so the answer on the changes, there haven't been changes that would affect a level term assurance policy, or a term assurance, decreasing term assurance, which you sometimes see attached to mortgages. So that's not caught within the changes from 2027. A big thing to consider on that, though, is if the policy is written to pay into a trust or not. So if it's not, the default position is that the proceeds of the life assurance would be paid into the estate and therefore subject to inheritance tax of 40%. However, if that policy is written to pay into a trust, the proceeds will not enter the estate and therefore be exempt from inheritance tax. So I think there's a key point there on reviewing the policy itself and ensuring it's set up in the right manner. And just a slightly related point, not term assurance, because as I say, that won't be caught by the changes, but a bit of a niche point that may affect some people. Some older death in service schemes that are via an employer that are linked to the pension scheme trust that dictates a final salary defined benefit pension, some of those will fall within the scope of inheritance tax because of these changes. So worth having a look at that if you've got death in service in place. A lot of newer schemes won't be caught by this, but certainly we see some clients who have older schemes that are linked to a pension scheme trust. So definitely worth having a look at that if you've got that sort of policy in place.
Perfect. Thank you, Ben. We'll get into the rest of the Q&A now. So Sean, first question through this evening. Do the new rules to pensions apply on first death, and therefore will a spouse miss out? How does the inheritance tax interact on that?
Yeah, great question. And didn't really cover it in any detail in the presentation, so we can pick up on it now. So I think key part here is to understand that the IHT does apply on first death. And I think the question is probably alluding to the fact that with IHT, there is a spousal exemption on first death, which allows you to pass assets from one spouse to another, with IHT not due at that point. And then on second death, IHT becomes due on the whole estate. Now, that will still apply from a pension perspective. So if your pension is set up with an expression of wish to pass to your spouse, and on your death, the pension passes to your spouse, then there will be no immediate IHT to pay. If your pension expression of wish is set up to pass to anyone other than your spouse, then there would be IHT to pay on first death. So I'm glad that question was raised because it allows us to make the point that your expression of wish nomination is really important, even more so going forward. Now, these rules, again, just to reiterate, don't come in until April 2027. So as part of your estate planning strategy, if you already had perhaps your children set up as your expression of wish on your nomination, it might still be right to keep them as the nomination until the 6th of April 2027. Then at that point, it might be right to consider, okay, do we want to buy ourselves a bit of time for when the impact of IHT will impact the pension in the family, and therefore change that nomination to the spouse and have that potentially as impacting on second death. So hopefully that's answered the question around that IHT is due on will impact on the first death, but depending on how your pension is set up to be nominated, will depend on when the IHT actually becomes due.
Perfect. Thank you, Sean. Ben, I'm going to come back to you straight away because we're getting quite a lot of questions on gifts out of surplus income and how that works. So we touched on this in what we talked about earlier. I think a few individuals maybe benefit from just a brief example. If you could just talk through how gifting out of surplus income might work if you begin to take an income from your pension and when that might be relevant, because it's not always the best strategy, as we know you're going to pay income tax on the income that you do draw from the pension. So perhaps you could just work through a couple of these, maybe work through a real life scenario or a case study that you could talk about in terms of how that works.
Yes, so I suppose there's two questions there. It's what income qualifies for this exemption and how to set that up properly, and indeed the circumstances where drawdown income might be useful for this purposes. or these purposes, should I say. So on the first point, really important to point out, income is laid down in HMRC's legislation. That is things like income from pensions, so defined benefit final salary pensions, state pensions. It can be drawdown income from a SIP, for example, which is key here. It's income from things like rental, investment income, so dividends from shares, interest from things like corporate bonds, interest from cash. So it is true income, and not drawing capital. So that's really important to point out. And the next important point is that this income, net after tax, must be demonstrably excess. That is, you have covered your expenses in normal expenses, that is fixed overheads, but normal discretionary costs as well in your average year, and therefore it is truly excess. So to take an example, if your net income as a married couple after tax was 70,000, yet you spent just 40,000 of that, and there was a £30,000 excess, which is very clearly in excess, and you can gift away without affecting your standard of living on a regular basis, then there is an opening here for this gifting out of surplus income. And one of the things we talk to a lot of clients about is making sure that there's good records in place. So, when the time comes when one's executors have to demonstrate all of this to HMRC, it's very clear what the income was, and what the expenses were, so it can be looked at and picked through, and it can be clear to HMRC that it was indeed excess. And another thing that we often suggest to clients is writing a letter at the start of this process to make all of these things clear and make the intention clear, and indeed the intention that these gifts will be regular. So there's quite a lot to this exemption, always worth a discussion on it. But moving on to the point of how can your pension, defined contribution pension, or SIP with Killick, be part of this. So drawdown income can be income for these purposes, as aforementioned. So let's say you do have that excess. Take that example, there's already a £30,000 excess using those figures. You could draw further funds from your drawdown pot and boost that further. I think our view is where that is really worthwhile doing is where you've got basic rate tax bracket left. So you could be drawdown income from a SIP, paying 20%, and then if that money drawn after tax qualifies as surplus, then it can be gifted and immediately outside of one's estate for inheritance tax purposes. So whilst you're taking a 20% income tax hit, you are saving 40% on death subsequently. As I say, quite a lot to this exemption, so always worth having a sit down and going through everything in detail.
Yeah, couldn't agree with you more. There is a form available on HMRC's website to help individuals with that. Rather boringly, I do know what the form is called. It's the IHT 403 form, and it just records household income, household expenditure, and therefore the surplus, so that you can record whether you're making gifts out of that or not. And it is treated, generally speaking, sort of as a household, but you want to be making sure that you're working through those calculations properly, as Ben says. Sean, I'm going to come back to you quickly in terms of tax-free cash. Now, this was something that there was a lot of speculation about beforehand. We've got a question here this evening. Do we think that tax-free cash is an element that the Chancellor may look to come back to at a later date? They need more taxation.
Yeah, spot on, Will. I think that was something that we were hearing a lot in the press pre-budget. A lot of clients were asking questions around our views on, do you think there's a chance that the Chancellor reduces the amount of tax-free cash for pension savers? And I think our position on that has remained the same, that for pension savers that have diligently worked hard to put money away in their pension pots over the years, to build that pot up inside the confines of the pension rules, with the notion that they were always going to get 25% of their pension pot tax-free, subject to previously the lifetime allowance, which has been removed this tax year, but is now capped at the lump sum allowance. For a government to effectively renegade on that commitment would really call into question people's trust in the tax system, and something that we think is very unlikely to take place. And the reason for saying that is also based on previous changes in pension rules over the last almost 20 years since the pension lifetime allowance was introduced back in 2006. It was an element of sort of lifetime savings that you have for your pension pot that grew up to a point of 1.8 over time, and then subsequently reduced from 2012 onwards all the way down to nearly £1 million. And along that journey, each time then it reduced from 1.8, it went to 1.5, 1.25, and down as low as £1 million. Each time the tax-free cash that was applicable, 25% of that sum, you always had the opportunity to lock in that previous high of lifetime allowance and pensions tax-free cash. So whenever they've made changes to pension rules in the past that have effectively reduced people's allowances, they have given pension savers the opportunity to lock in. So it's probably a long way of answering your question. We'll say I don't think there's a risk that the Chancellor would arbitrarily reduce everybody's tax-free cash that they've already accumulated with that lump sum allowance in play. But again, I guess go back to the point that I made earlier about the potential for these IHT rules be changed in the future. We have no way of being able to foresee what a future government might do, but actually hopefully that bit of history around pension rules and the changes that have happened over the years give, I guess, people out there who are considering and concerned around their tax-free cash allowance being removed a bit of reassurance that we think that it's unlikely to be the case. And I'd always say, if you are in that position, it's a big decision when it comes to thinking about taking tax-free cash. You're fundamentally changing the makeup of your pension, and current time that would mean bringing those funds out of your pension wrapper, which is, as we know, really tax efficient, back into your own estate from an inheritance tax point of view. So it's not a decision to be taken lightly, and I would recommend anyone thinking about doing it just chat to an advisor before doing so, just for a bit of counsel on whether it's actually absolutely the right thing to do for them.
Yeah, large financial decisions potentially massing into the hundreds of thousands of pounds. I think it's generally a good idea to seek some form of advice or counsel, whether that's buying a house or accessing your pension. There are a couple more. Rachel, I'm not ignoring you. There are some questions I'm going to direct your way in a second. But
Thank you.
we do have we're really into the weeds on the pension questions, and there's just two more. There's one more pension question I want to cover off, and then one on the gifting rule, and then there's going to send some your way. Ben, while we are in pensions, we've had a few questions around how final salary pensions and defined benefit pensions are treated under this new regime, which you sort of touched on earlier, but maybe it's just worth expanding on that quickly. What element of that is going to be taxable? If you're an individual who's in payment, how is that treated? You know, where is the tax here on defined benefit pensions?
Yeah, so we are waiting for some of the nuts and bolts on that, because defined benefit pensions can vary quite a bit from one scheme to another, depending on the scheme trust and the rules contained within it. But from what we know so far, it looks like it's lump sum death benefits associated with these final salary or defined benefit, more broadly, pensions. And what that means is, so most pensions, when the pension holder dies, there will be a spouse's pension, which is typically 50% or 2/3 of the income you were due to get. And there then can sometimes be a lump sum as well, which is sometimes a function of the annual income. So it might be 5 years of income, three perhaps. So it's, from what we know at the moment, it looks like it's those death benefits which will be caught under this and treated similarly to a defined contribution pension, like a SIP, where it's a lump sum added to the estate and there's inheritance tax payable on it. What this means is that for some people, your final salary scheme won't be caught in this if it doesn't have those benefits attached. But as I say, it varies quite significantly from scheme to scheme. So I think it's another opportunity to have a look into what you've got, the scheme, and take stock of everything.
Absolutely. I think a key thing for anyone after the budget is going to be taking stock of how the changes have impacted them, and that may be just simply getting putting themselves together a net worth statement, looking at everything they do have, working out what used to be subject to inheritance tax, now what isn't, and potentially now reviewing what the impact of that is on their beneficiaries and how much additional tax might be due. And then you can begin to think about what to do thereafter. Now, Rachel, I promised some questions to you, so I've got a good one here for you, and potentially quite a long one to answer as well. How do you see the budget changes impacting on the UK's economic outlook in the short, medium, and long term? And do you feel this may be impacted by the upcoming change in leadership in the US as well? So we did have the election the week after the budget, so it was a double whammy from that perspective. How are things looking now from a market perspective?
Yeah, it's been a busy time for us. So looking at the UK then over the shorter term, as we touched on earlier, it is likely that the budget will be a bit inflationary, and that will mean that interest rates in the UK will have to remain higher for a bit longer. So that's a negative for growth. So we don't expect to see particularly impressive growth here in the UK over the short to medium term. That said, I think the UK does have too much debt at the moment, and therefore I think it is good that the government is doing what they can to try and reduce that level of debt by raising taxes a bit. So I do hope that will pay off over the longer term. Having a look at the new leadership in the US, I think that could potentially have an impact as well. So Trump is very keen on tariffs, as we all know, and the UK does export a few things to the US, cars, for example. So we may see some tariffs there, which may be good news, or maybe bad news rather, for economic growth. What could also have an impact on the UK economy and the UK stock market is the relationship between the pound and the dollar. So since Trump won the election, we have seen a big strengthening in the dollar and a relative weakening in sterling. And we've actually got a lot of companies in the FTSE 100 here in the UK that earn their revenue in dollars and report their profits in sterling. So with a stronger dollar and a weaker pound, those companies suddenly look more profitable, and therefore the share prices have gone up. So that's a bit of good news in the short term there. But longer term, very, very difficult to say.
Perfect. Thank you, Rachel. I'm sure you will give us more and more updates on your weekly market update as we progress through the next few years anyway. Sean, I'm going to come back to you again. There's a lot of questions in here about gifting, and look, at the time we aren't going to get around to answering all of them, but I will pick out just a couple more questions from the list that we've had. Are you able to give us a quick comment again about the gifting from a pension, which is not already in drawdown? I think gifting with pensions in particular, we've had a couple of questions there, straight questions about can you gift a pension?
Yeah.
I mean, just give us a bit of an overview there.
Yeah, thank you. I think as a starting point, in this context, you can't simply just gift your pension wrapper during your lifetime. Just to clarify, pension is something that belongs to you and can only pass on death. But the option I think we were talking about during the presentation was the ability to put your pension into drawdown and then start drawing an income in your own name. So that would be subject to you paying your marginal rate of income tax on those withdrawals in the tax year that you make them, and then using that income to gift to whoever you might want to benefit from. So I guess that's where we're talking about using your pension to gift during your lifetime. It's actually a way of drawing out of your own pension and then using those funds to gift, rather than actually gifting the pension wrapper itself to somebody else.
Thank you, Sean. Good summary. And then I think a couple more questions. We've got a little bit of time. So Ben, we've had a lot of questions on the 7-year gifting rule, how that works. Have there been any changes to it? Do you just want to give us a quick overview on how that 7-year rule works and what the current situation is?
Yes, so quick answer to has it changed? No, that hasn't changed as a result of the budget a few weeks ago. The way it works is if you make a gift which doesn't qualify under one of the exemptions, so for example, gifting out of excess income is an exemption, the £3,000 gifting exemption, if it doesn't fall into any of those, it will either be a potentially exempt transfer or a chargeable lifetime transfer. And the quick summary of that is if you make those gifts and survive for 7 years from the date of the gift, that those funds are outside of your estate for inheritance tax purposes. So you save up to 40% on them. Whether a gift is a potentially exempt transfer or a chargeable lifetime transfer, that depends on whether one gifts to an individual or an absolute or bare trust, or in the case of a chargeable lifetime transfer, a discretionary trust. But broadly, if you gift and survive for that 7-year period, the funds are outside of your estate. Another key thing to look at is if those gifts themselves give rise to an inheritance tax charge, that is, they are above your nil rate bands, then actually after 3 years, taper relief kicks in, and that is an annual reduction in the rate of inheritance tax, so from 3 to 4, 4 to 5, and so on. So it hasn't changed, and the 7 years is the aim of the game, I suppose. But there's some complexity there around whether the gifts are to a trust or not, and indeed one should consider taper relief too, because that could be pertinent to the rate of tax depending on how long someone survives who's made a gift. And I saw a question on the chat also about if you're gifting to a junior ISA for a grandchild, just for example, do those gifts fall under that 7-year rule? So if they don't qualify for an exemption, they would fall under that 7-year rule. So you have to survive for 7 years to save the inheritance tax. But those gifts could qualify. So if it was a gift out of excess income, for example, that into a junior ISA, that wouldn't. So again, it's all about considering the personal situation there.
Brilliant. Thank you, Ben. We've also had a couple of questions. I was going to ask you the one about gifting into a JISA from a grandparent. So thanks for covering it off anyway. But we have had a couple of questions about trusts. Now, trusts is something that we have done specific webinars on in the past as well. So if you want to find out more about trusts, please do let us know. Reach out to us directly and we can send you the link to our previous webinar on that. It's also available on YouTube. And we will likely do more in the future because the question we've got here, Sean, is are trusts now more suitable as a way to potentially mitigate inheritance tax? And within that, also maybe worth looking at how does the 7-year rule interact with the trust element?
Yeah, no, good question. And I think for anybody that had perhaps a relatively sizable pension pot where their strategy was they were just going to let that roll up over the next 10, 20, 30 years, not necessarily need to draw an income from it because they had other sources of income, whether that was their ISA, perhaps a main account with investments in there, or maybe secure income from other sources. So in a situation where part of their estate planning, their IHT planning was really centered around that pension piece and just treating that as the vehicle that they would use to pass on to future generations outside of the IHT net, suddenly having to revisit that strategy and considering that from 2027 onwards, that pension is going to form part of the taxable estate, now means looking at other ways of reducing the estate from an IHT point of view. And I suspect that's where this question has come from around, suddenly do trusts become more attractive? And I think in that context, for those individuals, perhaps they suddenly will become more of a topic of conversation and consideration for them when they come to putting together a well diversified, well orchestrated estate plan to try and mitigate IHT longer term. Pensions, as you say, sorry, not pensions, trusts, we've covered in detail in another webinar, so I won't go into details today around the various types of trusts that exist and the way that they can help individuals sort of reduce their IHT liability. But I think, Will, the question was around the 7-year clock. So very simply, if we look at and consider potentially a discretionary trust, allows you to pass capital from your own name into that trust structure. And from the day you put the money into the trust, you effectively start a 7-year clock running on that gift into that trust under what we call the potentially exempt transfer rules. That is effectively a 7-year clock running from the date of the gift. Should you survive that 7 years, that gift into the trust falls outside of your taxable estate from an IHT perspective. And then the trust itself will sit outside of your estate going forward, not only the gift, but also any growth that trust has had within it in the preceding time and sort of going forward. So hopefully that answers the question, kind of the two elements of that question that was raised.
It hopefully does. It also probably brings us to an end for this evening, because we have now reached the hour mark. I'm going to apologise to everyone who we haven't got around to answering questions for this evening. As I mentioned, what we will do is arrange for someone here at the firm to reach out to you directly to provide an answer to your question on email. In fact, we'll do so for anyone whose questions were submitted today, because we have had quite a few through, and we just want to make sure that everyone feels that they got what they were looking for from this webinar. We will thank you all very much for your attendance, for your interaction. It's been a real pleasure and great to see so many questions and so much interest. Please do continue to follow us for more information and more webinars over time. And if we can help in any way, please feel free to reach out directly to one of our advisors. Have a good evening from myself and the panelists. Thank you very much.